Welcome back to Primary Source China Investment. Peng Guo and I are here with show J5, and we wanted to remind viewers to start looking at Chinese companies based in China for Chinese consumers. You know, all the oxygen in the room is taken out by the Alibabas, Meituans, Tencents, Pinduoduos, Jingdongs, and Baidus of the world. But investors holding these names have gotten a lot of volatility and a very bad risk-adjusted return. And if you haven't adjusted your risk-adjusted return based on what's been happening in China, you haven't been paying attention. We've been talking about this for about 18 months, and we're imploring investors to do three things: stop, look, and listen. When we say stop, we mean stop simply following the allocations predetermined by the large index companies and the effective marketing of product issuers. MSCI has been lobbying to get more China into more indexes globally. And while that may make some sense on a GDP basis or on a stock market size basis, it hasn't helped educate investors to look for stocks and sectors that have earnings growth, transparent accounting, transparent ownership, and mainland customers. A lot of that is the unsexy B2B instead of B2C retail product. And finally, listen. Beijing has been signaling for 2 years, whether that's dual circulation or common prosperity, that mainland-based entities are the priority. So what does that mean for the short term and maybe even the medium term? Well, here's a clue. CSI State-Owned Enterprises Reform Index. This is an index that is developed by CSI, obviously, on the mainland. And some of these names we've covered, but these are the mainland names that have mainland clients and, most importantly, government ownership. So we're going to get through a few of these names, but Peng Guo, what's your initial thoughts on the entire business cycle and some of the information that we're getting out of Beijing in terms of policy and reform?
I think right now we already see the China-Asia market get down, especially last week significantly. And I think the China policy and the China government, they already realized this series of the economy, and they are facing the big trouble. Generally speaking, the policy should favor the business as well as increase the liquidity in the market. But in reality, I think people lose the confidence. So this is a pretty clear signal. And also they try to sell down everything and never come back to the market. But the Asian market always like that. If you get the increase for 3 days, and every day said that the bull market is back. Yeah. People's memory always like 7 days is like short term. But seriously, it's a good opportunity for the long-term investor. Like you said, they have to figure out what kind of the company they can grow and grow in the long term. A lot of the Chinese companies, the business model, especially business model, significantly different from many companies, Western companies. People get familiar with it. So this business model could change significantly, and it could be broken the box and get a much more profit in the long term. China, as announced, still have the 1.4 billion people at the second largest economy. So definitely is opportunities in this bad time period.
So that's what I want to talk a little bit about is some of these names in this index. They're not sexy names. There's a lot of large, entities that employ a lot of people, a lot of B2B. Yangtze Power is a good example. China Construction is a good example. They don't get a lot of coverage, but these companies are employing a lot of people. Their performance is not necessarily affected by what's happening with the consumer, because the consumer is still going to turn their lights on. The government is still going to make things. This is sort of like the value play of China, And some of these names on the financial services side, like ICBC, they traded a 4 PE and a 7.5% dividend. Anybody that's been to the mainland can see ICBC on every block, in every town, in every province. So there's a lot to like about some of these what I'll call unloved names. And people may push back. Oh, financials, they're going to have a lot of issues. They're going to have a lot of default. The non-performing loans are increasing. All that is true. But also on the other side, on the asset side of the equation, you have massive, massive deposits. And when you have massive deposits, you have net interest margin increasing. So I do think the best Chinese banks are a place where you can find a lot of safety and a lot of long-term potential upside, along with a very favorable dividend.
That's absolutely true. And also, people need to do the deeper research, like the financial sector. So if you just understand why the last time financial sector gets sold, you probably can figure out when you should buy the financial sector in the next time. I think another time is with probably around 10 years ago. I don't remember exact time. So it's really like the China economy reform, economic cycle changes, and the many micro factors get them together and then push the financial sectors get up. Similar things for other sectors. So they have a different cycle, and you have to understand what's the bottom and what's the up, and definitely buy low.
Yeah, but buy low and not necessarily hold forever, because things do change. We've talked about this a lot on this show. China is not a set it and forget it market. If you've set it and forget it, I was having an argument with somebody a while back. The Shanghai Composite hit a high in 2007, and where the Shanghai Composite sits today is 50% below that 2007 high. That is a sobering thought if you're a set it and forget it investor. So you do need to be a bit more, dare I say, active when looking at China top down. What is Beijing saying? What's happening with the consumer? And those are the two things that you have to square. And right now, we're seeing the safest place and the most potential at this moment happens to be with those large SOEs fully aligned with policy in Beijing.
Yeah. Another maybe easy way is just track the leading companies. So leading companies in the different sector also change. For example, like Alibaba, right? So the price gets dropped down for many months. And actually, Jack Ma is already returned back and also makes significant change. Right now, the seller open their store get much faster than the Pinduoduo. So it's attracted the sellers back to their platform, and also they might find other growth area in the platform. So those kind of things may be easy. Focus on a couple of the leading companies and track their change.
Unfortunately, a lot of those names have a lot of headline risk at this point.
Yeah.
so those are the things you can't model. I mean, fundamentally, they may make a great case, but there's exogenous factors that are really hard to model. Investors that don't want a lot of volatility will probably avoid those kind of names. But that's for a different show, and we're going to leave it here with show J5. Thanks for tuning in, and we'll see you next week.
Thank you.